Hey everyone, my name is Luke Davis and I'm here with Jody Davis at Capital Wealth Management Group. Over the past few weeks, a lot of you may have noticed the uptick in volatility and the more noticeable swings in the market. After such a strong stretch of performance earlier this year, the change in pace can definitely feel like a shift. So today, we wanted to zoom out a little bit and take a look at what's actually going on from a broader, more long-term perspective.
That's exactly right, Luke. When markets go from calm and steady to a little choppier, it always grabs people's attention. But what we're seeing now is very consistent with how markets have behaved after strong rallies. Periods of exceptional performance are almost always followed by periods of healthy, normal volatility as investors assess interest rates, earning expectations, and economic data. And none of that is unusual. It's just part of the market cycle.
And Jody, I know one thing clients always appreciate is context. Short-term swings feel big when we're living through them, but the long-term picture tends to tell us a different story.
Absolutely. And to illustrate that, let's use this chart that tracks every bull and bear market going all the way back to 1942. What it shows is something incredibly important. Bull markets have historically lasted far longer and climbed far higher than the declines that interrupt them. The average bull market lasted more than 4 years and delivered cumulative gains of around 150%. In contrast, bear markets, which always feel dramatic in the moment, have lasted only about 11 months with losses of roughly 32%. When you line them up side by side, you see just how more powerful the long-term advances have been compared to the pullbacks.
And that really puts the current environment into perspective. Because yes, we've had a pullback, but we've also had a really good run this year.
Exactly, and we have seen this pattern many times before. What we're experiencing now looks much more like a mid-cycle decline within a bull market, not a departure from one. Remember, earlier this year when the market went through a roughly 18 to 19% drawdown, it was followed by a strong rebound supporting how markets often reset, consolidate, and continue higher. History overwhelmingly supports that staying invested through those periods is what benefits long-term investors the most.
So for anyone watching who's feeling the emotional side of volatility, the message here is that these movements aren't unusual and they don't mean that the long-term trend is broken.
Exactly. I mean, it's certainly uncomfortable at times, but it's also temporary. And when you look at nearly 8 decades of market history, the takeaway is consistent. The long-term growth of bull markets have far outweighed the shorter, sharper declines of bear markets. This chart makes that incredibly clear. Volatility is part of the journey, but it's not stopped long-term investors from reaching their goals.
Well, Jody, thank you for breaking that down. That perspective is incredibly helpful. If you have questions about your portfolio or you'd like to revisit your financial plan, we are here to help. As always, thank you for your trust and your partnership.